Hi everybody, Adam Walkom here from Permanent Wealth Partners. I wanted to give you an update on current market conditions and market levels and our thinking around it. So it's currently the end of October 2022 and we've had a situation over the last few weeks where financial markets have moved from the financial pages, which is frankly where they belong, to the front pages of the newspapers and also the 10 o'clock news and also internet news sites and things like that. When that situation happens, which it does from time to time, the sort of fear levels from most people goes up because the way that the press generally reports financial information is like the way they normally report most other information, which is trying to provoke as much fear and as possible to get you to click and watch and do all those things. What I'm going to do here through this brief video is explain to you exactly my thoughts in terms of where financial markets are, what's caused us to get to this position, and then frankly some of the views, my view and our view going forwards in terms of what we can expect. So this video is quite important, I think, in a way, because we have seen a lot of volatility in financial markets over the past month, if not year. And so if you feel this is, you would like to share this video with friends or family or colleagues, for anyone who has sort of questions or feels nervous about financial markets, please feel free to share this link. More than happy for them to watch and get an understanding on my view. So without further ado, let's kick off and have a look at a few charts and give you an understanding on what the thoughts are. Before we move on, let me just remind you from our regulatory and compliance perspective, anything that I'm going to discuss here is frankly just my personal view and is general market commentary only. This is not financial advice. If you have a question, anything relating to your personal circumstances, please get in touch and we can tailor everything to your personal objectives and needs to create the best possible outcomes for you. Anyway, moving on. Now, to start with, let's focus on the equity markets or the share markets. Now, as you know, when we look at investing is across asset classes, and we have an equity market or a share market, we have bonds, we have property, we have cash, we have other bits and bobs like that. However, when most people think of financial markets, they think of the equity markets, and this is the FTSE 100. This is the S&P 500 in the US, the Japanese Nikkei 225, Europe has the Euro stocks. All of these are the main equity or share indices where the biggest companies in the world are listed. And so this chart is a chart of the FTSE, of the FTSE All Share, which is a conglomerate of all the biggest UK index, and goes back to around the mid-80s. And what it shows is the grey columns are the performance on an annual basis, both up and down. So you can see here we've had, these is reasonable positive performances here, and then with the odd negative performance here as well. So 2008 is a good example. The FTSE All Share was down 33% in that year. Now, what the red dot means is okay, so that was the year-end performance, but the red dot also means the peak to trough performance for that year. So given the fact that the FTSE All Share was down 33% in 2008, that red dot at minus 43 means actually at one point, potentially, the FTSE All Share was actually up 10% for the year, and then it dropped another 33%. So it shows the biggest fall, or what we call drawdown. And so just to roll forwards to this year, and this year you can see the FTSE All Share currently is down around 10 or 11%. Now, to be fair, that's actually performed quite well relatively versus the US market is down around 20% so far this year. The US market, obviously the biggest and most liquid market in the world with the biggest, most well-known companies in the world. But we use the FTSE on this one for a barometer. So why I put this chart up is because from an equity markets or a share market sell-off, actually this year so far has been relatively frankly mundane. Yes, it's annoying, the fact that markets have been selling off and valuations are lower. However, from a long-term perspective, there is certainly nothing out of the ordinary from a share market perspective. And even you can see from the biggest sort of sell down being minus 30%, in fact, that looks quite mild compared to what a number of these other years have been. So, and the US, as I said, is similar. It's down about 20, but the US tends to have bigger ups and downs as well. So it's still very much in line with historical averages. So when we look at, frankly, the share market sell-off, we are effectively starting what we call we have started what we call a bear market. So a bear market is where effectively we have a sell-off, from the top to the bottom it starts around 20%. That's a broad-based definition. Frankly, the simplest definition for a bear market is where stocks go down versus a bull market where they go up. And then, so when we think about that, and if we continue to focus on the equity markets, we're just moving over to the US for a second, because this just gives a guide in terms of actually what we've seen in terms of the bull markets in green and the bear markets in grey on this bottom chart. And in between the bull markets, we have bear markets. And as you know, this is what we've discussed about before, around the ups and downs of global markets. And so here, from 2009, post-financial crisis, we've had a good old bull market here. We had that brief sell-off, or that, pretty big sell-off, but very brief, of the COVID-based sell-off in March 2020. And, this bear market so far has only been relatively short at 9 months long and relatively mild at 25%. And again, looking back through history, there are shorter ones, there are longer ones. Again, it's hard to kind of bring, this goes back through to 1958. So it could be this, we could be at the end, we could be in the middle. It's very, very hard to tell in terms of where we are from a historical context. But again, what it tries to show you is that very much, we have bull markets most of the time. We have bear markets for a short period of time. We're just in that phase at the moment where we're just going through a very ordinary bear market. And it's frustrating and it's annoying, but it's just, frankly, part of the cycles of the market. And then when we go through bear markets and markets are selling off, what we look for is, okay, frankly, how cheap does valuations get? And markets get overbought at some times, and the valuations rise because everyone thinks everything's going great, and then they sell off, and then they sell off to a point where things become cheap. And I think in terms of this, the forward price to earnings ratio is a great number, or a great value, a multiplier that we use to value actually how expensive markets are. And simply, this is a case of what a price to earnings ratio is the case of the share price, or in this case the index price, versus the total estimated earnings that the underlying companies are producing. And for these, you can see here the range of estimates historically is the grey column, up and down for the US, Europe, UK, Japan, emerging markets, and China. So the grey is the column. The average since 1990 is the green bar. Where we were at the start of 22 is the dark diamond, and where we are currently is the lighter blue diamond. And you can see for this year, all the value multiples have dropped so far. But I think what is really interesting in all of this, yes, and now we're below the average since 1990 in all of them, and really kind of with the exception of the US, for a lot of these sectors, being the UK, Europe, Japan, emerging markets, China, we really are down at some of the low end of the historical ranges since 1990. And so I think this is interesting. So what we're finding is, bear markets finish when, frankly, multiples become so cheap, people just think, okay, we just have to buy these things now. And so you could there's an argument that we're kind of approaching that area on China, on emerging markets, on Japan, on UK and Europe, and the US maybe not. But again, you can't just use the multiples as one factor. It is only one factor. You can't just use this as the determining factor, and investors don't. They merely look at this as one of the sort of barometers in their toolkit to give them an understanding, or to give us an understanding on where and how cheap markets are. So I thought that's interesting that the conclusion around this is that valuations are below average and approaching kind of the end the extreme end of sort of cheap valuations, with the exception being the US. And now the problem therein lies that the US is the biggest market in the world. with the most liquid, with the biggest companies, and so the US has a huge impact on what the rest of the global markets do. But if we double click briefly then on on a home bias in terms of UK, here you can see when we look at this PE ratio, or price to earnings ratio, you can see the average for the UK since the early 2000s there is 14. And actually now we're down at below 9 at the end of September. So from a valuation perspective, the UK market is pretty darn cheap. And we're going back to the brief times it's been around this level were the global financial crisis here and early or mid 2011 there, which was the European debt crisis. So that was when we thought that Greece was going to go bankrupt and then take Portugal, Italy, Spain, and all those countries with it. And so markets saw a big sell-off there. So overall, when we look at equity markets and financial markets and share markets there, we've seen markets have sold off. It's been unpleasant, but it's very much in line with traditional market sell-offs. And frankly, we are approaching points where a lot of these markets actually look to provide some half reasonable value in terms of where they are right now. So the equity markets, you think, okay, well, why is there such a commotion? Why are people so worried? And so the answer to that is, okay, we can conclude here it's not the equity markets that have seen where the real impact have been in terms of financial market sell-offs. In fact, it's been the bond markets. And most of you, we've had discussions before in terms of how we construct portfolios, and most of you have sort of portfolios with majority of equities in there, but also some have a certain amount of bonds in there. Because traditionally, bonds are meant to be the stable ones, and bonds are meant to be the diversifiers and having what we call an inverse relationship with shares. And that inverse relationship means as one goes up, the other is meant to go down, and that's what financial theory and the asset allocation models have traditionally taught us. But unfortunately, in this case, that seems to have fallen down, and I'll explain why. So what we've seen here is in terms of government bonds so far in 2022, I love this chart, this chart goes back to 1701. So Bank of America have done a great job, and I don't know how they've collated all this data, but it's pretty impressive. So this is what they call the World Government Bond Index annual return. So this is collating all government bonds from around the world. And this year, so far in 2022, it has been the fourth worst year since 1701 from government bond performance. So when we talk about once-in-a-lifetime events, it's safe to say that this has been a once-in-a-lifetime event. The last time it was as bad as this was kind of the UK coming off the gold standard. I should know what year that is, but it's somewhere around the 1930s, and then the Marshall Plan being introduced in post-World War II. But since then, bond performance, and you can see the impact, the bond performance hasn't been anywhere like as bad as it has been here. So when we look at the damage done to portfolios, equity component in the equity markets, yes, it's been not great, but it's the bond market where the real damage has been. And the reason for this, frankly, is interest rates, and frankly, the main reason around this is the monetary experiment that we've conducted, that as the world has conducted almost since the early 2000s, of 0% interest rates. And so investment theory goes the way that government bonds are priced, so is effectively a relation to the current interest rate. And so there is a very simple formula, which means as interest rates go up, the value of government bonds and all bonds goes down. And there's a slightly more complicated way in terms of calculations, but that is the simple truth. And because the way the bonds are valued are not like shares, which are done on future price expectations and earnings. Bonds are simply a mathematical formula. And with that mathematical formula, interest rates go up, bonds go down. It's that simple. And so where we've got to from effectively having interest rates at zero, like we had during the lockdowns and COVID, and how quickly those interest rates have risen in the past, let's call it 9 months, that has effectively been reflected in how bad bonds performance has been on the downside. And going further than that, in terms of the previous chart was the global government bond performance, and actually this chart here is the UK 30-year gilt or 30-year bond. The UK has actually been worse because of the extremity or the extreme of pace of interest rate rises. And so this is effectively the UK. This was as of this was as of like last week, and we saw this is the yield you will get on 30-year government bonds. So the yield is the interest rate. So back at the start of 2022, call that 2%, call that 0, let's call this 1. It's just below 1. When you were going to buy at the start of 2022 a 30-year UK government bond, you would effectively receive an interest rate of about 1% per year, every year for those 30 years, and you get your final bond payment back at the end. Now that's changing that now to, as of about a week ago, this was up at 4.6. So you'd receive 4.6% per year every year. That is huge. That's a kind of a multiple of 4 move, which is what caused significant damage to some of those pension funds, which prompted my note from a couple of weeks ago. The issue was you saw some of those pension funds, they had big collateral holdings of bonds, and the valuation of those bonds just dropped very, very quickly, and it caused them to breach some of their regulatory limits in terms of their collateral limits that they held, which caused some forced selling. That's what the FCA stepped into and stopped a couple of weeks ago, and they stepped into the bond market and acted as a buyer, and that's what this little sort of up and down here was the FCA stepping in. So the problem there was you saw such a quick move that the pension companies and other investors, or large-scale institutional investors who hold these bonds as collateral, didn't have time to do their normal portfolio mixing and changing and selling and buying and things like that, because it just moved so quickly and they breached some of their limits. So that's what frankly caused the main stress in the markets from a couple of weeks ago, and the FCA stepped in. Now, subject to this little chart is a week or so ago. So we've had some of the worst moves in UK government bonds that we've seen in a while, which sounds really bad. But the interesting thing is, as of today, we've actually seen that's the FCA. It's actually worked, and it's worked for a number of reasons. So clearly, one of the big sell-offs was the idea of the mini budget, and the markets didn't respond well to that. I think, frankly, again, my very personal view, they got the mini budget, and Liz Truss and ex-Chancellor Kwarteng got a little bit unlucky with that in terms of the timing of the mini budget. So because on the day the mini budget was released, 24 hours later, the markets had not responded at all. As in, everyone knew what had been released, but the pound hadn't moved, bond rates hadn't moved. Over the weekend, there was some stress in the US markets, which caused the US dollar to gain and the pound to fall aggressively. That then sort of a follow-on effect in terms of the way that these bonds moved as well. And you saw this big run-up in the bonds here that put everything under stress. What's happened since then is bonds have actually, this is now the 10-year gilt, it's actually come off. And it's down around 3.5%. And the main reason it's come off is because there's now effectively an expectation that interest rates rises in the UK cannot continue to go at the pace they're going, because the way that they've gone so far nearly broke something within the financial system. If they keep going at the pace they're going, something else may break. And so this sort of falling here of the bond yield is an expectation that the Bank of England is not going to continue to raise rates as aggressively, because given a choice, the Bank of England has a choice between, dealing with slightly higher inflation for slightly longer, or ruining the financial system again, or breaking the financial system, holding the financial system together. They're always going to choose the financial stability side versus inflation. And that's what the market is pricing as well. Now, this actually is more relevant for most people in terms of mortgages as well. So you've seen, mortgages, yes, got a lot more expensive because on variable rates, mortgage rates track these bond yields and interest rates. So this is really important from a mortgage perspective, because if we have reached peak interest rates in terms of peak bond yields here. And if bond yields continue to fall, now this is an if, remember, this is not definitely going to happen, this is an if, then you will see mortgage rates, the extreme mortgage rates we've seen, should start coming down. And so this is very, very relevant for anyone who's got a mortgage. Apparently there are, I read the other day, that between 60 and 70% of all mortgage holders have some sort of fixed term coming up for expiry in the next few years. So, that is the majority of mortgage holders, because most people sensibly locked in very low rates while they can. The risk, though, is people are rolling off a 1.5% deal into a 5.5% deal. Now, in anyone, no matter how rich you are, that's going to make a big deal in terms of your financial spending capacity. The Bank of England recognise this. It's a potential stress to the system. So when thinking about financial stability, that's another reason they can kind of consider this and think, okay, this may not be the most sensible course of action to continue to raise interest rates. That's what the market is thinking about now. The other thing that is happening is there is a clear economic slowdown within the UK markets, within the UK economy, mainly prompted by slower growth. And again, frankly, the Bank of England potentially caused this when Governor Bailey stood up, probably a few months ago, and said that the UK is going to enter recession for 3 years. I mean, talk about a dampener a good way to dampen the animal spirits of the market. Look, whether he did this as an active ploy to try to get people to growth to slow down, but the simple fact is, frankly, for inflation to slow down, the central banks need growth to slow down a bit. So they're using their communication and their speech to try and talk the economy down a little bit. Now, as per usual, central banks, they go over the top, and they either raise, it either goes way too much or way too much one way or too much the other way. Let's see. My point around this, though, the key point around this is if you have a mortgage that's coming up for expiry in the next, let's say, couple of years, again, without wanting to, there's potential, and this is not advice, but there is potential that actually rates may start to come down in the next few months, and frankly continue to come down as rates should come down as we go through economic softness. So hopefully that's some good news. I've historically talked about what to do if you've got one of these big cliff edges with interest rates going up, and the idea that when you look at across the whole risk of your financial situation, a whopping great mortgage is a big financial risk, and the idea of frankly the idea of allocating some funds potentially, instead of adding to investments or adding to pensions, potentially using those funds to reduce that debt is potentially a good idea. If you've got any questions on this, please get in touch, because this advice is very much personalized around your situation. So I can't give, this is everything I'm talking about here is very generalist. Every situation is different. Everyone's going to have a different circumstances. So please get in touch and we can kind of talk through your situation and talk about what's best. But the overall philosophy, the overall theory is if we do continue to slow economically, I see rates actually falling further, and therefore mortgages should come down. So then going back to, that was talking about bonds again, so that was just a side on mortgages, but going back to bonds again, this chart here, we talk about the idea of, historically, the idea of bonds and shares being inversely correlated. So as one goes up, the other falls. And so this chart again goes back to about 2000 and looks at the classic kind of 60-40 stock bond portfolio. So traditionally that's what we would call a balanced portfolio with 60% shares and 40% bonds. And it looks at the overall performance, with the performance of the shares being in light blue and the performance of bonds being in dark blue. And you've had the odd time where both have worked the same way. In fact, a lot of these years, actually bonds did quite well, while share markets did quite well. But in some years where share markets have fallen, you've seen actually bonds, all right, sometimes they haven't actually helped, but there's not, here they have, and there's no great damage done, with one exception being this year. And so you've seen this big sell-off in bonds, which actually has made the overall performance sell-off in these balanced portfolios look far, far worse. And frankly, that's been the biggest, the major impact in terms of what we've seen for a lot of people's portfolio performance. There's been the double whammy of not only have the share markets fallen, but the bond markets have fallen as well, which again is highly, highly unusual based on recent history. However, if we go back further, this is looking at the rolling bond equity correlation. Since, about 1995, we've seen it. We have a negative correlation between bonds and shares, which means as one goes up, the other goes down. But actually, through the 1950s, through up to the early 90s, there was actually a positive correlation between bonds and shares. And there's a question mark. Are we going back to that scenario now, where we get both working at the same time or both not working at the same time? So this is very interesting in terms of how this, what the impact of this is going to have to future portfolio construction. And this is something we're thinking about a lot. We're talking to clients about, we're discussing this with our clients, and as per usual, it very much relates to your own circumstances, but this is on our radar. And it's something that we need to consider very carefully in terms of how we do this and how we look at portfolio correlation. Because certainly for where we are right now, there's a high chance, certainly for at least the next year or two, that we go back to this positive correlation scenario with shares and bonds both moving in the one direction. So that's a bit of a summary in terms of where we are from a bond market perspective and then how that relates to a share market's perspective. So another factor I will talk about when looking at actually the scenarios out there now, there's a lot of doom and gloom out there in the world, as per usual, and this actually then gets reflected in cash positions by fund managers. I'm just going to move myself over here. Sorry about that. If I move myself over there. And so overall cash position, this is a fund manager survey run by Bank of America Merrill Lynch. And so when we look at a comparison between, so the typical fund manager holds something between 3.5% to 4.5% cash in their portfolios. And if they're holding less cash than this, it means they're very bullish, and actually, funnily enough, that's a contrarian sell signal. So that means that they're fully invested and they don't have any more cash to invest, and so we're likely to potentially see there's more likely than not that we'll see a sell-off in the future because the fund managers have less cash to put into the market. On the flip side of that, if they're holding more cash than this, it's a contrarian buy signal because they're hoarding cash, and when markets, or when they feel more confident in markets, they've got this cash to allocate to the market, so buying power and liquidity to push into the market to push markets up. So that becomes a contrarian buy signal. The interesting part, this was the survey back in April 2020. Now remember, April 2020 was right at the end of that massive lockdown, COVID sell-off that we had during March, where the markets fell 40% in like a month. And this was April 2020, where it's a very large cash position held. And we know what happened post-April 2020 was the markets went on a run for about 18 months, and a very, very strong bull market started then. At that point in April 2020, this was the highest cash levels since the 9/11, which was 2001 terrorist attacks. So very high cash holdings. So that was then. That was April 2020. If we fast forward now to the latest survey, so that was 5.9 back in April 2020. Today is even higher at 6.3. So again, fund managers are like the rest of everyone. They're nervous. They're scared. They're nervous. They are holding a lot of cash out there, which means there is a lot of liquidity and a lot of buying power sitting on the sidelines, waiting for some sort of good news out there. That's actually quite a bullish sign, because it means that a lot of the selling has been done. So it's just one of the things that we look at and how just as a guide in terms of where we can go from here. Now, the key problem that markets have faced, which again is not going to surprise anyone, so I'm going to move myself around again, is inflation. And really, it's this big inflation bogeyman that has risen aggressively over the last couple of years. And frankly, this is a case of when you turn, yes, you could blame oil price. Yes, you could blame the war in Ukraine. Yes, you could blame Chinese supply chain issues. The principal cause of this, because look, when inflation started rising, it was inflation started rising towards the end of 2020 and then just rocketed in 2021. The principal cause of inflation was the fact that we went through during 2020 and all through lockdown, the entire global economy went through the first recession in history where people actually made money and were paid money to stay at home. And so there was this, people saved on average, the average savings rate skyrocketed during lockdown, because people were still being paid through furlough schemes, or they were doing professional roles or whatever. And again, I'm not, there's always going to be individual cases where this didn't happen, but on the whole, savings levels rose significantly across the entire economy. Unsurprisingly, when people then were let out of lockdown, they had a lot of catching up to do. And that's what we saw, this big spending of demand, of people wanting to do things and travel places and buy things and go places and things like that. And that's what caused this big jump in inflation. And then after that, the first problem was the fact that the supply chains weren't set up to deal with that. So all of a sudden prices started jumping higher because not everything was in the right spot. And also then the oil price jumped because Ukraine, and then China kept doing this rolling lockdowns, which meant things stopped, goods stopped being produced. All of this kind of have built into one to make inflation the problem that it is today. This is the main problem that we're all facing, is because central banks are raising rates quickly to try and stamp out inflation. Because what happened is during the 1970s, we had this series of years of high inflation, which wasn't stopped until until interest rates went to sort of 15 and 16%, if not higher. It was principally by Paul Volcker in the US. And so that our central bankers at the moment understand that high inflation is the biggest problem that any economy can face, because it also massively generates inequalities between the haves and the have-nots, because everything costs more, but if you've got more money, you can pay that. And by the way, you can if you own a business or whatever you do, you can charge more and you can be compensated for that inflation. For the lower earning in our society, they don't have that power, and it just massively increases the inequalities. That's a massive issue. And so this is why we've seen such fast interest rate rises, to try and stamp this out as quickly as possible. The problem we've seen is that inflation data that's coming out, which is the CPI data, is remaining to be rather stubborn in terms of how high it is. It's not coming down quickly. And so therefore you've seen continued central banks making comments that we have to stamp out inflation. We're going to do whatever it takes to try and reduce inflation. And that means try and squash, effectively growth, which is what's been happening over the last 9 months. So this is the problem, frankly, with global markets, and this is frankly the biggest reason of what has caused financial markets to sell off in the last 9 months. It's been this inflation that has peaked and is somewhat sticky in terms of refusing to come down. Now, I think the stickiness is the interesting part, because what is as I mentioned before, inflation should come down as we move into economic softness. And so I think what's interesting in terms of some of these charts here is actually there are certain prices across the economy where things are coming down. The most relevant here, if you look at the top left here, is the price of UK natural gas. This is the wholesale price. So it's back to frankly where it was over pretty much as an average for this year. We had a big spike over the summer, but the gas price is down to where it was. So the huge ongoing expectation of increased gas prices is not, that potentially is not going to happen, because look at that gas price come down. So that should be passed through to the retail, we hope soon. I never quite know. This is trade routes. So this is how much it costs to ship one shipping container from Shanghai to a number of countries. So Rotterdam, LA, Genoa, New York, all of those come down significantly. The price of oil, again, peaked at around $120 a barrel, down now, it got as low as 80, but now sort of picked back up a little bit, now sitting around 90. The price of copper again, a major kind of input in terms of industrial metals. Again, peaked at about 440, now down to about 340. And finally, if I just move myself here, US wage growth. So this is wages. So again, this is where it gets a little sticky again, because this is passing on, companies passing on higher wages. And, it's starting to soften a little in terms of coming down. Again, it's still relatively high, well above 5%, turning towards 10%, but it is starting to come off a little bit. So again, these are the sort of further input prices that should start to feed through into that inflation data soon. And we should start to get that weakness coming through soon. It's just going to take time. And that's the problem that we're facing, is that, yes, you've got the slowing economy, you've got weaker input prices. We just need to feed that through into the inflation data. Excuse me. Because without that feeding through to the inflation data, that's what's hopefully going to prop that. It's harder for the central banks to kind of make comments that they're going to ease up on the rate rises. So there's a lot of information there, so I'm going to summarize. And the best way to summarize is talking about the bull and bear case. So the bull case, again, I'm not into forecasting. I'm not going to tell you exactly what's going to happen because no one has a crystal ball. But what I want to do is give you kind of the ideas of which, call it the pros and cons of this market at the moment. Excuse me. The bull case, reasons to be positive. Markets are below average on valuation. So we've had a pretty good sell-off so far in 2022. For a lot of markets, frankly, they're cheap, in inverted commas, and they're below their average valuation. The US being obviously the caveat around that, it's below average, but it's still not down at the bottom end. So we may need to see some further pain in the US, but let's see. Cash is high amongst fund managers. So there's a lot of fund managers out there holding a lot of cash that can be put to work. Bonds have had the forced sellers, which has taken some pain away. So what we saw is that forced selling in the UK bond market over the last couple of weeks potentially has signaled a top in those bond yields, which is correlated in inverse in terms of it's potentially a bottom in the price of bonds, and we've seen those price of bonds pick back up. That could be often at turning points like that, you get some sort of what they call market clearing events. Potentially we've had that now. And this idea that the positive bond equity correlation could work in investors' favour during recovery. So this is actually a bit of a thesis of mine right now, and again, just my thesis. If we get interest rates falling, we're going to get bonds actually starting to work. And at the same point, if interest rates are falling, we should get equity markets potentially working at the same time. So both share markets and bond markets potentially moving higher together, which is a positive sign. So let's see. That's the bull case. The bear case. So far, we've had, and let me just move myself around here. There we go. The bear case so far, in terms of when we look back at the history of bear markets, this bear market has been relatively short and has actually been relatively mild so far from an equity market perspective. So we've seen the idea of that. So therefore, there could be more to come. The bear case, ironically, cash is high amongst fund managers. That's also actually potentially bearish because it means it's high. They're not buying at this point. So let's wait and see on that. Inflation is sticky, not coming down yet. I talked about that just before. Other financial stress points may appear. So like we had with 2008, where if you remember back to 2007, 2008, markets were seemingly recovering through 2008 until they let Lehman Brothers go under, and then that caused all manner of contagion effects. The pension crisis we saw a couple of weeks ago that the Bank of England stepped into, again, we may see some other kind of event that just appears from nowhere that has some sort of contagion. Who knows? And finally, the other bear case we've seen is the big tech earnings and guidance that has come out of the US in the last few days has been poor. So yes, their numbers have been poor. That's, I say poor, but versus historical standards, that's fine. That's the previous quarter. That's old news. But what is interesting is their guidance hasn't been very positive going forward. So a lot of these big tech companies have been guiding slightly lower in terms of their growth. Now, why is that an issue? The main issue is that because big tech makes up such a large part of the overall, particularly the US market. I think tech is around 26% of the US market. So generally where those large tech companies move is where the rest of the market moves. So that's not that's generally, it's going to be interesting to see how that works itself out. So that's it. So that's my summary. That's just kind of tries to give you a bit of a balanced approach in terms of where we're going to go. Principally, going back to what I said right at the start, markets go through in cycles. We're going through, the share market have been through it's a very normal dip that we're going through that we should come out of soon. The bond market has been through a rather extraordinary dip, but again, it does show signs that that may have reached bottom and we may be coming out this other side of that. So I guess my final point is be very careful what you read about in the press, be very careful what you hear on the 10 o'clock news, because a lot of the information that has actually come out, especially on the front pages and of the papers, the 10 o'clock news actually has me sitting I have my head in my hands due to the unfortunate lack of understanding in terms of what causes the moves to financial markets and what the implications are. And the cause and effect relationship is always very complex in financial markets. And unfortunately, it's very hard to reflect that complexity into a 30-second soundbite. So that's why you generally, in a 30-second soundbite, it summarizes A happened, therefore that caused and result equals B. And I guarantee you that's not always the case. So please be careful what you read, careful what you watch. If you've got any questions, always feel free to give me a call and we can go through your situation. At the same time, if you feel as though if you found this video helpful and you think it might be helpful for friends or family or colleagues, please feel free to share wildly. There's nothing on this here that's I'm worried about in terms of from a compliance perspective. This is all generic market commentary. So if anyone you know may feel better and you feel this may help them, please feel free to pass on this video. So hopefully that's been helpful for you. If you've got, as I said, any questions, always feel to reach out. But I'm sure and I'm hoping to speak to you hopefully in the next few months and catch up as we normally do. So all the best and speak to you soon.